Hi, this is your market in a minute. Today, we'll recap market last week and we'll be taking a closer look at the current market landscape. Market recap. The Bank of England has lowered its rate to 4.5%, the lowest level since June 2023. Despite the cut, inflation is expected to rise to 3.7% later this year, driven by higher energy, water, and transport costs. The BOE predicts inflation will return to its 2% target by late 2027, about 6 months later than previously forecast. U.S. employment reports. Job growth continued in January but at a slower pace, with non-farm payrolls reaching 143,000 jobs. The unemployment rate held at 4%, reinforcing expectations that the Federal Reserve may cut interest rates only in June. The labor market's results gave the Fed room to pause rate cuts, while policymakers assess the inflationary impact of the Trump administration's tax policies. Market ahead. Consumer Price Index, USA. The CPI measures inflation and shifts in consumer spending. It's expected to stay at 2.9%. Higher than expected inflation could raise concerns about prolonged high interest rates, affecting market sentiment. Growth and tech stocks may be hit hardest, as they are more sensitive to interest rate changes. On the other hand, a lower than expected result may increase expectations for Fed rate cuts, which could boost tech stocks as they benefit from lower interest rates. Gross domestic product, UK. The UK economy grew strongly in early 2024, rebounding from a brief technical recession at the end of 2023. GDP rose 0.7% in first quarter and 0.5% in the second quarter. The economy saw zero growth in the third quarter, and economists expect only minimal growth in the final quarter. This is likely due to stagnant services, a 0.7% drop in production, and only a 0.2% rise in construction. Gross domestic product, Eurozone. The Eurozone economy grew by 0.7% last year and is expected to pick up in 2025. Inflation reached 2.4% in December, mainly due to rising energy costs. It is expected to stay around 2.3%, with core inflation easing to 2% by the end of the year. As the Eurozone continues its gradual recovery, inflation and labor market dynamics will be crucial. The US plans to impose a 25% tax on all steel and aluminum imports. In response, the European Union must choose between a direct retaliation or a strategic approach, potentially targeting US tech services or goods. Stay tuned with Excent Capital. Good trades.